Wall Street Unplugged looks beyond the regular headlines heard on mainstream financial media to bring you unscripted interviews and breaking commentary direct from Wall Street right to you on Main Street.
Amir Adnani, what's going on? President, CEO, founder of Uranium Energy. It's been a while since we had you on. How's everything going, man?
Frank, nice to connect with you. It's been a while, but yeah, I think last time we connected was it February or January of this year?
I think it was January. You made some really bold calls back then, and more timely, right? You're like, we always knew the supply demand and balance. We saw that the last few years. We saw more countries coming online. It's just everything was there with the fundamentals, but you were really adamant in January saying, listen, prices are going to double, and it's really nice for a change because we finally have something good to talk about after 13 years.
That's it. Yeah, we've been at it for a long time, but it's finally starting to, it's been 13 bad years and now 45 good days.
Well, what has changed like in this year? Because like I said, the fundamentals seem to be there, right? The supply demand imbalances we talked about for a while. I mean, are we looking at more bipartisan stuff? I know there's a lot of bills in the work. Is it the sanctions that have taken place on Russia? I mean, what is specifically taking place where people are finally like, okay, I get it, and you're seeing this price really move? We could say tremendously because it's been low for so much, but in reality, it's we could still see it go much, much higher from here.
As always, it takes a combination of factors to work together at the same time that are years, maybe decades in the working. Which causes the price to make the kind of move that we've seen the uranium market have, where we've gone from basically a decade of the price being around $20 or $25 per pound. It was like watching paint dry, just it wouldn't move, right? To about a year ago, moving up to about $50 per pound, pulled back around 45. And now in the last 45, 60 days, it's moved hard and past all those levels to a new level of $75 per pound. So the price is very strong. But to get to here, there are some longer term trends, Frank, that have been in the making. There are some near-term trends, and it's all coming together. So what are those things in no particular order? People like to say that we had 12 bad years in uranium. I would argue we've had 20 to 25 bad years in uranium. And what do I mean by that is if you actually look back over the last 20 years, in the last 20 years, we've had a total cumulative 2.5 good years and 17.5, 18 bad years. So bull market rallies that we had in 2006, 2007 only lasted 1 year. That's not enough to really build an industry around, especially in mining, which is a long dated industry, capital intensive. The 2008 financial crisis cut that rally short. In 2010, we were starting to have a uranium market rally, and that was cut short by Fukushima. The 2010 bull market lasted a total of 6 months. Can't build mines in 6 months. And prior to that, we had the end of the Cold War. And in the early 90s, when the Cold War ended, we have to remember that the US basically offshored the whole nuclear fuel complex to Russia. It was a way to reduce the stockpiles of the former Soviet Union. The whole treaty that was signed, basically the highly enriched uranium treaty to dismantle these Soviet-era warheads, created a new source of uranium that wasn't a mine, but it had a strategic outcome for the US government to destockpile the Soviet Union warheads. That killed the uranium mining industry as well. And that was a issue for a long time. So these are 2 decades of various trends that we've witnessed that basically has caused us to be in a place on the supply side of the equation today where we have a structural deficit. There isn't enough supply in the world to meet demand. Supply this year is expected to be 145 million pounds. Demand is approaching 200 million pounds. Okay. But all these years, we had available above ground inventories. The Japanese are a really good example of that. The country of Japan shut all its reactors down after Fukushima. They had inventory. That inventory helped balance the market. So even though there was a supply deficit, the market was being balanced by Japanese inventories. So here comes the game changer number 1. Japan earlier this year and throughout this year announcing that on the back of strong public opinion support, for the first time since Fukushima, the public opinion polls support reactor restart. And the Japanese government now has the mandate where the president and the upper house and the lower house of their parliament has said, we're restarting reactors. Now, all of a sudden, overnight, available Japanese inventories have disappeared. You have a high interest rate environment. If you were a trading company and you were trading uranium, you'd be thinking about how to trade around the low interest rate environment. At high interest rates, you can't do that anymore to do what used to be called the carry trade. And then finally, policy. The policy coming out on nuclear energy is the most bullish we have seen ever. And in fact, just yesterday, it's incredible the timing of this interview. Just yesterday, the US government announced that at the upcoming COP28 event, this is the gathering later this month in Dubai for all the climate kind of community and all the issues around reducing the global temperatures. COP28 event, the US government and the UK plan to get everyone to sign on to a pledge to triple nuclear energy globally by 2050. Previously, the same target was to double nuclear energy by 2050. So earlier this year, when I came on your podcast, that was the backdrop. The backdrop of growing demand was that the world was looking to double nuclear energy by 2050. As of the last 24 hours, that figure and that target has now been revised to a triple. There's your demand side, there's your supply side.
So has there been any change, I guess, in sentiment, right? Because remember how, we need to lower temperatures and climate change, but you can't do it through nuclear. You can't do it through uranium, right? That's terrible. That's horrible. And now I've seen, even people have movies on it, liberal, people coming around more to it. Like you said, just the policy and the actions. I mean, it seemed like this was such a stretch a couple of years ago. Why are we seeing it now? Are people just finally realizing, like, hey, you know what? This makes the most sense. 24/7 baseload power. It's cheapest energy. It's the cleanest energy. Let's stop messing around. And if we really want to focus on, reducing carbon emissions and focus on climate change, I mean, it's right here. It's right in front of you. I mean, have you seen this sentiment change finally? Because I don't know why the climate change crazies are so against this.
Well, let's talk about this. In 2006, when we had a uranium bull market, when prices went from $40 to $140 per pound, okay? Tesla as a company was a year old. Tesla was formed in 2005. By 2006, it was a one-year-old company. If we think about Tesla as a barometer of how electrification and EVs have come around, right? Today, we know the size of company it is. Today, we know how much of a, let's say, product line EVs are. And the whole concept and the whole trend of electrification is one, let's say, driver of interest in nuclear energy. Because with electrification, it changes the requirements around the electric grid and how utilities have to supply power to customers around the clock. Let's talk about artificial intelligence. Artificial intelligence is a very important growing segment in the IT world. But artificial intelligence would require a ridiculous amount of computing power at data centers in order for it to become a reality. Today, the biggest discussion taking place is around IT companies, technology companies, Silicon Valley, and the utilities, the energy providers, to understand how they can provide the consistent power that data centers need to support AI objectives. That is the reason why Bill Gates is getting behind TerraPower. And that's why Microsoft has announced plans to build small and advanced modular reactors. That's why today the biggest voices supporting nuclear energy are people like Sam Altman and Bill Gates and Elon Musk. And the other day, Ken Griffith, who came out, the billionaire founder of Citadel, talking about this, because the industrial applications of nuclear energy, data centers for AI or space travel for SpaceX, all these require nuclear energy. And that's bringing a whole new segment. So electrification, number one. Number two, decarbonization. If you're a climate scientist and you've been tasked to sit down and talk about and figure out how the world can achieve net zero by 2035 or 2050. There's not a single climate scientist in the world today that has looked at that and hasn't come away saying, we need nuclear energy in the mix. So once the question was posed to the climate community differently, and this time the question posed was, how do we decarbonize and how do we hit net zero targets? And they looked at it objectively. The math and science is driving the equation, and the equation is we need nuclear energy to meet these climate goals. And then the third, energy security. Russia invading Ukraine changed the whole landscape when it comes to thinking about the availability of energy that you control. When Russia basically uses its energy resources to drive its foreign policy, to basically hold Western Europe hostage. And you know, Frank, what America's dirty little secret is? We criticize Germany for being dependent on Russian gas, but guess what? America is just as badly dependent on Russian uranium. And that is one of the key reasons why, to your point about policy, the one thing that in Washington, the Republicans and Democrats agree on right now is nuclear energy and the need to get off of this Russian addiction that we have. Russia is still supplying more uranium and nuclear fuel to the US. And we need to, and that is the reason why we're trying to stand up a domestic industry, why the US government is buying uranium, why this issue is one of, again, national security, security of supply, electrification, and decarbonization. And the confluence of all those things coming together is what's driving broad acceptance of nuclear power like we've never seen before. Policy that's basically making governments and policymakers say we got to double, forget it, no, we got to triple nuclear energy output. And for the first time, Frank, that I've been doing this, for the first time in 20 years, I can say to you now that the US as a market is a growth market for nuclear power. It used to be that if you said to me, where is the growth coming from in nuclear energy? The answer was, this is a China-India story. Today, China and India are still growing at the same pace as before, but the US is expected to double its nuclear energy capacity just by launch of small and advanced modular reactors in the next 20 years. That's an estimate from the Nuclear Energy Institute. So the US is also a growth market. By the way, that's before the announcement 24 hours ago about the tripling target. So that's exciting. It's actually exciting for me to finally know that the market in my own backyard where I'm developing projects is also growing. And it's not just, oh, we're going to sell this stuff to China. No, it's the market in our own backyard that I think is actually the most dynamic market. And it's cool to have the Silicon Valley entrepreneurs in this. It's cool to have Bill Gates as an advocate, Sam Altman, Elon Musk. These guys have a different way and view of looking at business and growing businesses than utility companies. Utility companies that own the existing reactor fleet are the most conservative businesses on earth, right? If you run a utility company, you've been taught your whole life how to not take risk, right? And so you got to have a different attitude and mindset to find growth in any arena.
Do you talk to any of these guys? Because I know you travel everywhere. I know you're probably going to Dubai too next month, if I had to guess. But I mean, do you talk to any of these guys? Have they starting to approach you now and come up to you and the Bill Gates of the world and you know these large hedge fund managers and people who are not really so much into uranium, which they're into now?
No comments. Stay tuned.
It's always a tight knit. You better tell me that offline. I'm curious about that. But listen, guys, I need you guys to understand this because when you're saying Russia, right, is your main exporter. This isn't like China with rare earth minerals. This isn't where we have no choice, right? That's why it's such a big story that some coal company just found some rare earth metals that they won't be able to develop for like 20 years from now. Nobody tells you that. But Europe has no choice, right? They have to import that natural gas, right? I went to your facilities and I remember you showing me boxes. It was almost like from a movie, like you could dust off stuff and you're like, how much uranium is in the United States? And you know exactly where it is. I mean, we have it here. The oil companies just produce uranium like crazy, but again, 70s, 80s, laws change and you know, can't do that anymore. We have it here. I mean, we got to see not just the U.S. come around and say, okay, we're supporting this industry, but I feel like, and you know the numbers better than me and how much we really have here. If we really want to supply this stuff, especially even through Canada, which we'll talk about in a minute, we could actually do it. I mean, we have it here. It's not like we have to be dependent on Russia. Have you seen that conversation where, okay, now we really, let's start producing this stuff now because we have it here. It's actually here.
U.S. led the world in uranium mining in the 70s, late 70s. The country is totally blessed with uranium deposits and geology throughout southwestern U.S. states of Texas and Wyoming, and historically in places like New Mexico, Colorado. And so this is not a situation where, like you say, the deposits don't exist and, you know, Mother Nature wasn't kind to us, etc. It's all there. We used to lead the world. At Cold War ends, as I mentioned, we decided to, in a way, offshore this, outsource this to Russia. And today, the big trend is that the US is looking to repatriate the nuclear fuel cycle. That's what's happening. And it's uranium mining, it's conversion, it's enrichment. The Nuclear Fuel Security Act that's making its way through Washington right now as we speak will most likely provide billions of dollars of government funding to further provide a boost to the domestic industry that you're talking about. The US government and the Department of Energy have been studying this for years, since the Trump administration. It started back then. They studied the question that you just raised, which is, if we got behind this, is the capacity there? Is the potential there? And the answer is a resounding yes. It requires funding support and policy and market conditions and all of that. But that's what's happening right now. And Frank, following the interview that I did with you earlier this year, we were very proud as a company to announce that we supplied uranium to the United States government, the Department of Energy, as part of their maiden program to stand up the Strategic Uranium Reserve, which is now the US government's equivalence to the Strategic Petroleum Reserve. Mm-hmm. And the fact is that the US government sees and has studied this and sees that this is important of national security matter, but that if you support domestic industry, it has the capacity and potential to ramp up. So when they came out to buy uranium earlier this year, it was only $60 million worth of it. And I say only because the government has announced that they intend to buy up to $1.5 billion worth of uranium. But this initial small purchase made it very clear that they want to buy from US companies with US assets, with a US pedigree, with US-based operations. And so again, it demonstrates that they see the need for this. Now, what does the domestic industry look like today? Unfortunately, it really still is not much. The domestic industry today is producing less than 1 million pounds annualized, and demand annualized is approaching 50 million pounds, 50.
That's insane.
So it's an incredible gap that has to be bridged. It's going to take time, but there is no way out other than making this work, because we can't depend on Russia. There's already a bill in the US Senate looking to ban Russian uranium imports, but there's the threat that Russia might do a counter sanction, because for them, it's also a strategic outcome of saying, why am I going to sit around waiting until you guys cut me off? I'll cut you off first. Mm-hmm. And Russia is 40% of global supply. And through their influence and ownership of mines in Kazakhstan, they control basically the world's largest uranium producer, Kazakhstan. So they are in the driver's seat. And the objective now is to basically catch up. And as you know, the chairman of my company, Spencer Abraham, who is the former US Energy Secretary, he tells a great story. He says when he became Energy Secretary, the US was importing 50% of its oil requirements. And no one thought that that could ever change in a meaningful way. And through policy change, through innovation and US capital market approach and US approach to building industries, we know the end of that story. US not only addressed the dependency on foreign oil imports, but it became even an exporter of hydrocarbons. Same thing can happen here. The potential is there, the American ingenuity is there, the capital markets is there, and the deposits are there, and the history is there. The industry 40 years ago used to lead the world, was number one, US production. We used to produce over 40 million pounds per year, and today we're producing less than 1 million. This is going to change, and that's why I think I'm in a very high growth industry and why I'm excited about this.
Yeah, Spencer Abraham is like a badass. I interviewed him on the podcast a couple of years ago. He's a chairman, right? If I'm
yeah, he's the chairman of UC.
So when you go into that, because he's former Secretary of Energy, when you go in that office, is he your boss or you his boss? I mean, do you go in there and be like, "Hey, I need you to do this," or is it like, "Hey, do you mind doing this?" He's pretty intimidating. Even when I interviewed him, he's a great guy, but yeah, I don't know if I'd be direct and say, "Hey, I need you to do this for me. You need to go there and talk to these people."
No, I mean it's like, think about it. It's such a honor and privilege, right?
Mhm.
To have a former U.S. cabinet member.
Yeah.
I mean, first of all, we're the only uranium company in the world that has a former U.S. energy secretary. But to have any former U.S. cabinet members, not just energy, I mean, this is rare talent. It's a rare vantage point that individuals in that position of leadership have, and it's an honor to have that on your company, and it's a competitive advantage because you simply have a point of view and access and information that can really help shape strategy and can really give you a seat at the table or an understanding at the table that again becomes an advantage as well. I think we're just very fortunate that from the very early days, this concept really resonated with Spence, the concept that the US couldn't just be dependent on foreign exports forever and that this market would change eventually. This was years ago. This was before Russia's invasion of Ukraine. And I think we're fortunate that he had the vision, he saw it. It was a great alignment with what UEC's mission has been for almost 20 years. And again, we didn't, you never know how long it takes for these things to play out when you get into a business, but it's starting to play out. What we've believed in and have worked very hard in building as a company for nearly 20 years, all those reasons are starting to really come together to really spell out that in the next 5 to 10 years, the domestic uranium industry in the US is going to be one of the most high growth, exciting, fun places to be for investors and for companies and entrepreneurs and people that want to join the workforce. And it's going to take a lot of work and effort, Frank. You know, a lot of people have to be hired, a lot of jobs have to be created. It's going to be a significant undertaking, but that's what, you know, that's what growth is. That's what growth in any industry would be.
But the hard work that you've done, Amir, in positioning yourself for this moment, because you see when there's bear markets, people sometimes just get depressed. They're pessimistic. They're not optimistic like you are. But that period is so important to position yourself, right? I mean, and now that you're at this point, it's so important those years, right? And you think like, oh, the market's shitty, and I mean, those are the most critical years to me, because now when I look at, let's go into UEC directly, you're sitting on, you know, a lot of huge stockpile of uranium, right? 466 pounds, I believe, if I read that right. Average cost, you know, if you look at $70 prices is 32 million, 35 million, whatever it is. But you have your balance sheet. I mean, your balance sheet is 190 million in cash, liquid assets. I know you plan to purchase a lot more uranium through 2025, but have you ever thought where you're in that position to buy your stock back? And that's one way of using the cash, or without, I know that you've been using that cash to really, I mean, aggressively acquire assets. And I want to say at a brilliant time, right? You're looking at Uranium One, you're looking at Rough Rider, which I'd like to talk about even more and explain how important that project is and how amazing it is. But what do you plan to do? Because positioning yourself right now, I think, is so important. And you deserve a lot of credit for this, where a lot of people just could, you know, they get involved in other projects. I can't tell you how many people in the gold industry or uranium industry where they're like, hey, you know, they pitch me this stock and they're like, hey, Frank, I like it. You think you can get your subscribers aboard? You like it? I don't get paid by any companies, you know, and 3 months later, they're pitching me on another company that's totally different, maybe outside their industry. Like, it's not like that with you, where you position yourself to have a great balance sheet. You have that uranium. Now prices are high. You're making money off it. But what do you intend to do with that cash? Is there ever a chance of buying back the stock? Because it would be a significant amount. It would be probably 10% of the market cap, based on the cash on hand and you know, the liquidity available. Or is it, hey, you know what? Let's keep it. Let's get aggressive. Maybe you want to purchase even more uranium you think is cheap here, and continue to acquire assets in it. I'm curious to see, you know, what direction you want to go now that everything has been working out for you.
It's a great question. And the direction we want to go is at $75 uranium. There is a great price environment here to really restart our production and to get back into production with our Wyoming and Texas assets. The margins are going to be very good. And that's the best use of capital right now, is to really provide the necessary funding to our plans to become a producer.
What's the price, really quick? Sorry to cut you off. What's the price for that? I mean, I've told 50, 55. It could be different based on the projects. Do you have an average price?
Yeah, I think well, at least for our projects, which benefit from being built, like we're not talking about building a new mine here in Wyoming. The projects that we want to restart production are a restart. So they're already built. They were in production up until 2018. These are the former Uranium One assets that we acquired before Russia's invasion of Ukraine. And so there, we think the threshold, I mean, for us, the threshold always was 60. We wanted to see a $60 uranium price to restart production. And we wanted to see the price stay above $60 for a quarter to have a bit of stabilization before we make that decision. Well, price never got to 60. It went to 70. It shot past 60 very fast. And so we have a $70, $75 environment today. We want to wait, Frank, till the end of this year to, again, just see the price settle here, which seems to be settling really great, and formalize our restart plans in early New Year, so early January, and look to be in production hopefully by middle of next year. We want to make sure we're taking the steps properly. I don't think this is a foot race to say, oh, I want to be in production first. It's not first or second. There's a massive deficit in the world. Prices are going higher. You have to build projects and operations sustainably. And that's what we're aiming to do. We were, like I said, looking for a $60 incentive price. We have that plus more right now. And so this is a great environment for that. So to answer your question, that's the focus. The focus is not necessarily to be as acquisitive as we were. We were very acquisitive. We did more acquisitions than any other company in the world. Just in the last 3 years, in the last 3 years alone, we did close to $600 million of acquisitions. But we did $600 million of acquisitions when uranium was at $30 a pound, $40 a pound. That's when we were making our acquisitions. Today at $75 uranium, valuations are up. There's less to buy. Deals are not as attractive as they were when we were doing deals. But what is attractive now is the margin you can have if you're producing with $75 uranium. So that's where our strategy changes there. Physical uranium, Frank, we bought, you're right, we had, as of our last financial filings, we have close to just under 500,000 pounds of inventory on hand. But we actually had also signed contracts to buy an additional 1.5 million pounds at fixed pricing. So that was the other thing we did when uranium prices were low. We didn't just buy assets. We bought the uranium in a barrel as well under long-term contract at fixed pricing. So we'll end up, when it's all said and done, to have exposure to around 2 million pounds of uranium inventory. Now, 2 million pounds of uranium inventory today at $75 uranium has very substantial market value. Our all-in average cost there is going to be probably in the high 40s, but there still is a good margin there. And there's no CapEx and OpEx and permitting and technical risk associated with that. It's not a mine. It's just above ground inventory. Uranium prices go up, we can monetize some of that inventory and generate profits. Last fiscal year, for the period ending July, we sold $164 million worth of uranium, 3 million pounds, generated 50 million in profits, not from production, from our inventory program. So the inventory program has been a great warm-up act, a precursor to production, and then revenues coming in from production at higher uranium prices. So it's a good bridge, the inventory, to say, at $50 uranium, we still want to make money, and we've been doing that. At $60 uranium, we want to make money, but not from producing, from our inventories. And as uranium prices sustainably stay at these levels, production comes in as well, again, by middle of next year. And our competitive advantage, again, is that the production we're talking about is built and permitted. It's in Wyoming, it's in Texas, it's in situ recovery, it's low capital intensity, it's low labor intensity. And that's what shields our investors from today's challenges with building mines. The biggest challenge facing any mining company today when it comes to building a new mine is the high interest rate environment we're in. High interest rate environment makes everything more expensive. Mining industry is struggling, whether it's a copper mine or a gold mine or a uranium mine, to build big billion-dollar mines on time and on budget. We're not tackling a billion-dollar mine. We don't have any debt. I was marketing recently in Europe. Every question an institution first asked me, Frank, was, how are you going to refinance your debt? Because a lot of mining companies with existing debt, that's the issue right now. As your prior terms mature and your debt has to roll, you're going from low rates into high rates. That's going to kill margins. Our answer is a great answer. We're debt free. We don't have to borrow any money to go into production. We have 192 million of cash and liquidity on the balance sheet, debt free going into production that is also unhedged. So our production is not committed or promised to anyone. It's unencumbered. But in today's environment, to be built and to be debt free, I think those are really key advantages. And that's what really sets it apart. Now, look, if the rest of the industry struggles to build new billion-dollar mines, that's bullish for everyone, including those companies, because it means higher uranium prices for longer. Because today, the biggest issue is that clearly the supply side has to increase and grow from mining. And if the supply side takes longer to grow because of the challenges and headwinds we're talking about, in a weird, twisted way, that provides tailwinds for the price. Because it's a small industry, the industry collectively continues to benefit from elevated prices.
Yeah, and it's interesting on Wall Street. I mean, what have you learned, I guess, over the past, I would say, decade? Because you said that, when you're meeting these institutions, that they're asking about how to restructure your debt. They're saying that because they want to generate fees. And a lot of times, if they're not generating fees, sometimes even the smaller shops may not provide coverage on you. But you're sitting there without debt, and it's sometimes leverage is not a bad thing if you're in the right markets and the cost is manageable. But what have you learned there where in terms of coverage, is it more companies are going to cover you sometimes when you have debt? I feel like all these companies that cover Disney from 170 all the way down and just keep lowering their target price to 80 and to 90 they know that Disney's in a lot of trouble when it comes to debt, and they got to raise a lot of money in investment fees. But is there honest people that cover this industry that cover you, or is it kind of like that whole game behind the scenes? Because to me, I would be more focused on, hey, the fundamentals are great. Tell me about your company. Not like, how are we going to they didn't obviously even look at your balance sheet, right? They just came up to you and said, hey, how do we finance your debt? Which is great, right? You're giving away your cards, right?
Well, I think at the end of the day, the industry is collectively small when it comes to combined market cap. If you look at the whole industry, it's even today, it's combined market caps are less than $40 billion, right? So it's a small industry. It's going to be difficult for Wall Street to bank this industry. And I don't think the big banks, Frank, to your point, are sitting there and saying that, in their business plans for next year, they expect majority of their revenue is going to come from banking the uranium industry. So it's a small industry. Having said that, investment community obviously is interested in capital gains and good ideas and sectors that are kind of underfollowed and not understood. And so there's interest from the buy side. There's interest from the investment community, even if Wall Street doesn't see big banking potential here. And I think that speaks to the fact that, do you see Goldman Sachs and Merrill Lynch having uranium analysts that write about uranium every day? No, there is no such thing. This is still very much a bit of a niche industry, even though it's providing the uranium. Uranium is the fuel for 20% of electricity in the US, yet it's a niche industry, right? So it doesn't matter. It doesn't change our attitude. We're not here to try to generate fees for banks and investment banks. We're funded. We don't need debt. We're good the way we are. We are seeing some new interest from banks come in and pick up coverage, but doesn't mean we have to pay for that. Recently, we had, for example, UEC get coverage from TD Bank, right? That's nice. And more banks might pick up coverage, but they're also doing that because they see there's interest in the sector and in the company from their buy-side clients, right? But today we're covered by 7 analysts at UEC, all have buy ratings, and all have their price deck still at $60 a pound. So what's interesting to think about the sector is that the sector really has a lot of upgrades coming. The only analyst at one of the shops that actually doesn't cover us just recently upgraded his price deck. He moved his 12-month target to $90, and I think his 3-year target to $110 per pound. Remember when I used to say we're going to $100 a pound? Yeah, it sounded very bullish, or maybe Amir's just saying that because he's biased. You have now Wall Street banks with analysts with actual official price decks that are forecasting a 3-digit uranium price, not 10 years out, not 5 years out, but 2 to 3 years out. Wow. And that's just one analyst. So I think the sector has upgrades coming. I think as price decks get updated, valuations go higher. As price keeps moving, everyone has to keep up with it. And as we're keeping up with it, we have to keep up with changing policy landscape. As I said at the beginning, it's not doubling of nuclear energy anymore. It's a tripling of nuclear energy now. And that's not anyone saying that. That's the US government saying that, backed by the UK government. It's not a debate. It's a reality that is, the train has left the station, and now it's a question of the velocity at which this train keeps going.
It's funny because you say $40 billion market, guys. Just to put that in perspective, that's Square, which is now called Block. That's like 35, 37 billion.
What's Spotify these days? I used to always compare the combined market cap to Spotify, but
I
yeah,
mean,
it's
Spotify
something
too. I mean, Spotify is
exactly.
probably bigger than that, but it's just to show you like how small the industry is still, and yeah, how much it can grow, which is incredible to me. And also, I have to give you credit too. Just during those, I keep saying it during the times when things are not good. That's where you see the credibility. That's where you see like your team members who's for real, right? Everybody wants you to be a friend when everything's good, right? Everyone wants to be a friend. It's when things are tough. But just to have that structure in place where so many people might just be sitting on, hey, we're waiting for uranium to get better, where you're actually purchasing that uranium. And now you're benefiting greatly as prices go higher, right? And now you're participating. Now you have this optionality where you can do so many things. Okay, we could buy back our stock if we want. Well, we don't have to purchase uranium. Well, maybe we purchase more uranium here. No. Well, now prices are high enough where now we could actually start, supplying, right? Now we could actually start producing. So just having that optionality and being put in that position is amazing. And I'm going to ask you a question. This is a personal question, no right answer. Okay. I'm going to put you on the spot here. You've been doing this for a long time. You're still young. I consider myself young as well, but 20 years you've been doing it. I've been doing my stuff 30 years. You're a little bit younger than me. I just turned 50. Hate saying that, but I feel young anyway. But you come to the point where the hard work that you put in and everything that you position, now you're at a spot where, now things are starting to come to fruition. Now you're getting excited. You could say, okay, now we're starting into this growth trend. Is it like kind of this relief where you're like, okay, and you look at the next phase of where you want to be because you probably work 10 times harder. And now you're getting to this spot where some people are like, okay, maybe I'll personally take the foot off the gas a little bit and just now we have this perfectly positioned, which some people do. Or do you have the mentality where this is what I waited for? I'm all in. I'm going to be working 10 times harder than I ever worked. And both answers could be right because there's people who position their company perfectly. And they say the definition of the perfect company is you being able to walk away and generating money off it for the rest of your life. But personally, how do you feel right now? Do you feel more motivated, more excited, more than ever and saying, okay, this is where I'm going? Or is it like, hey, I positioned it right. Maybe I'll take a step back, come chairman and just, work on the contacts and work a little bit more behind the scenes. What is the next step for Amir Adnani?
I think it's just too soon, Frank, to really even think like that, because look, we had 12 bad years since Fukushima and we've just had 45 good days. Like it's just early days, right? It's not, we haven't really entered, it just happened. Like we've just had an inflection point where all this hard work and all this, let's say, platform building that we did, right, has finally kind of entered this period where now we're 60 days, 45 days into this, everyone realizing, oh, there's a shortage of uranium and prices are going higher. So I'm not sitting here and thinking about anything other than we're focused just as much as we were before. If anything, we're working 10 times harder because the transition to production, the work that we're doing I used to run a company that was just in Texas. Today we're in Texas, Wyoming, and Saskatoon. We have an incredible amount of assets that are being advanced and negotiated and joint venture. We have 5 joint ventures today, Frank, with Cameco, Orano, and these are on feasibility stage projects that were dormant at $30 uranium, at $70 uranium plus. They're going to become active again. So we're not doing anything other than just focus on execution right now. And luckily, I'm not at a place in age, nor is my team, where we're thinking about, gosh, we're getting long in the tooth. I was in my late 20s when I started this company. I'm in my mid 40s now. And I was fortunate to be able to attract the team. And some of the guys like Scott Melby on my team down in Texas who each have 20, 30 years of experience. I mean, in the case of Scott, 40 years of experience. But they're young enough and they're hungry enough. And we didn't have, we were in the toilet. There was no interest in the sector. And now there's an ability to do something, to increase production, to really grow the company. And I think everyone's very excited about that. And I think at the end of the day, ask me this question when you bring me back on the show and uranium is at $200 a pound. Ask me the same question then, and maybe I'll give you a different answer. But today, when we're, like I said, less than 60 days into an inflection point for the industry that we've waited 12 years for, why would you do anything other than saying, execute, execute, execute? Uranium prices are going to $200 a pound and higher. And let's revisit this question when that happens, and you and I for sure will be talking. But the way this market is developing right now, we haven't seen yet those days that we saw in 06, 07 when the spot market would make $5, $10 moves in one day. Because when you have a supply squeeze and you have no offers, every incremental pound of demand that comes in can have a profound impact on the market. And there's something very, I think, special developing here. I think the sweet spot, Frank, is going to be the next 2 to 3 years, because it's going to be impossible in the next 2 to 3 years to have a new mine just be built at the flip of a switch. It's just not going to happen. So this tightness that we're experiencing in the market is going to get worse and last a while. And then we just have to see again who can bring a new mine online. In previous cycles, when Cameco in 2006 had the flooding of Cigar Lake, even though it flooded because it was under construction. So
I remember when that flooded. When did it first flood? Because I think I was working for Kramer at the time.
It was in 2006. Okay,
and it flooded, and they said, "Hey, in 6 months we're gonna be fine." In a year, how long did it take? I mean,
well, here's the thing. It took a couple of years. It wasn't 6 months, right?
Yeah.
But in a couple of years, it became a mine, and it was 10% of global supply. Today, there isn't the equivalence of that under construction anywhere in the world. There isn't any new large projects currently under construction where you and I could say, look, there is no supply problem here, because look at that project and look at that other project. They're all under construction. They'll be online in 12 to 15 months. No such thing. And that gives us both runway. That gives the industry runway. That gives prices to go higher runway. And for entrepreneurs like myself, that's runway that we need to capitalize on. And that's what we're here to do.
Yeah, and it's so funny how you look at this industry the way differently, even the way I look at it. Even when it comes to me, when I look at marketing my business compared to having a really good stock, where I could be like to my marketing department, "Hey, this is a good stock. I'm recommending. I think it's a good idea." They're like, "No, it's not really marketable." I'm still going to recommend it, but they just look through different lenses than me to see what's exciting. Because when you say it's 60 days, for me, I think you're over the hump, right? I think everything here is just this, you pass the tough part. The U.S. is involved now. You have the strategic reserve for uranium. You see like a lot of those. It's almost like if you're breaking through this resistance level, right, and you break through it, you're there. Where, man, it just seems like I'm not looking at this like as hey, this is temporary and go back, right? For me, I think it has no place else to go but up, and that could be prices go higher in a while, but I just don't see them. Because I remember we were cheering not too long ago when prices, I think, went to 35, and I remember talking to you and being like, "They broke 35." We're like, and I think we joked around about it. Well, you remember when the prices where they were? We would have said like,
I remember that. I do remember that.
Which is crazy. But I guess we'll end with this, because I get a lot of questions, and I know the answer to this, but I think it's important for other people to realize it. So you're looking at Rough Rider, right, at the Athabasca Basin. Talk about that deposit, and talk about how it's different from the U.S., why that was a big deal. You're getting that asset on your books, because sometimes people don't know the difference between those two things. And I think that's really important, because to diversify and just buying of so many assets during this downturn and getting them so cheap, to me, I thought that was a steal for you guys.
Well, I think we have to step back, and for the benefit of listeners, especially if you're new to uranium, is to really understand that in uranium, unlike any other commodity, the way uranium can be mined is quite differentiated, in that roughly 45% of global production is from a method called in situ recovery. And no other metal, copper, gold, silver, solution mining doesn't play a role like this. But uranium is unique in that this method of solution mining, which is very low cost, very fast and just more advantageous, plays a big role. That's how the country of Kazakhstan has become the single biggest producer of uranium, is all in situ recovery. But for in situ recovery, this technology to work, the deposits have to be amenable geologically to this. They have to be in a sandstone setting. There has to be permeability, porosity, et cetera. And there's only so much of these deposits available. The other way of mining uranium is conventional mining, underground open pit mining, so strip mining. And strip mining or conventional mining is an earth-moving exercise. So you move tons of material, and grade is really key. Grade is, in fact, king, because the higher concentration of the metal in the amount of ore the better returns you get economically, because you have to move less earth to get the same amount of uranium. So grade matters a lot. And in conventional mining, if you're doing open pit mining, let's say in Namibia, the grade is 0.03%. If you're doing conventional mining in Colorado and Utah, the grade will be 0.3%. If you're doing conventional mining in Canada's Athabasca region, the grades could be 3%, 4%, 5%. This part of Canada just has unusually high grade deposits for conventional mining. So we felt for the longest time as a company that the best path of growth for us were these low-cost in-situ recovery projects and in the US. So we pursued as much as that, Frank, as we could. And we bought the biggest of this type in the US. And the biggest company in the US was Uranium One, which the Russian government owned. And we finally bought it from Russian control before their invasion of Ukraine. That was a great deal for us. That made us the biggest player in the US, which we still are. But post-invasion, we realized, geez, there's going to be a trend. And we're betting that there's a trend unfolding right now of Western utilities and users of uranium wanting to diversify away from Russia, which means North American supplies are going to become more valuable. So that meant for us that we wanted to make a strategic decision that in addition to our US business, we wanted to also be in Canada, because Canada has large, high-grade deposits that are conventionally mined, which wasn't attractive to do at $30, $40 uranium. But again, if you believe uranium prices are going to be sustainably higher than 60 and 70, this is a place to be, because these deposits could be very unique and special. So with that viewpoint, we made 2 acquisitions in Canada, a company called UEX, but then the one you like to talk about, Rough Rider, which is a deposit that was discovered in 2010. In 2012, Rio Tinto and Cameco got in a bidding war over this. Cameco started the bidding at $500 million. Rio Tinto closed the bidding at $640 million. Spent another $140 on mine development. In 2019, uranium prices are less than $20 a pound. Rio Tinto says, we're getting out of uranium mining. And by the time we bought the asset from Rio Tinto, they go through this long process to divest of their Namibian assets, their Canadian project, Rough Rider. By the time we bought Rough Rider from Rio Tinto, uranium was at $40 a pound, 45 maybe at max. And we bought it and we told the market, look, this is a world-class project, 70 million pounds of uranium at 4.5% grade, 4.5% grade. Remember, rest of the world is 0.3 or 0.03. So these are super rich. And we said, look, this will work when uranium gets to $70 a pound. And we said that literally a year and a half ago. And we bought it from Rio Tinto for $146 million. So we paid $146 million for the same asset that Rio paid $644 and spent another $140 million on mine development. So that is a wonderful deal for us, because that positions us with the project that we own 100% in Canada, right next to Cigar Lake and McArthur River, so near a lot of infrastructure. We brought in a Canadian team and led by James Hadley, who's our VP engineering now for production in Canada, who built Cigar Lake. Lots of experience there. In fact, when he was at Cameco, he was part of the acquisition team that tried to buy Rough Rider. Okay.
Well,
so he knows it very well. So we got a great nucleus put together of talent and expertise in Saskatoon to advance the Canadian projects. And Frank, today, when you look at UEC, you see a company that's highly differentiated in the marketplace, because in the market, you either have companies that just pursued Canadian exploration development or US exploration development. And we're the only company that's basically combined what I think is best in class in the Western world of US ISR projects that are going to be fast and lower cost to get into production, but believing that, hey, by the time you get your production up in the US with ISR, we're licensed for 8.5 million pounds per year. And you want bigger deposits to come online. And 5 years from now, 6 years from now we have a pipeline where we combine that US projects with the large high-grade Canadian conventional. And that 1-2 punch is differentiated. No one else in the market has put that together the way we have. And again, if you believe what we think, which is people are trying to move away from Russia, buyers of uranium want less Russian material, and they want reliable Western supplies. then I think the strategy in the long term will work out. And as you see energy companies, oil and gas companies enter the uranium sector, like they're doing in lithium. Look at yesterday's announcement with Exxon announcing they're getting into lithium production. You know who used to be in uranium mining? Exxon. You know who used to be in uranium mining? Chevron, ConocoPhillips, Texaco. In the 1970s, this industry's origin was ridden by the oil and gas industry. And oil and gas industry, which sees itself obviously as an energy business today, not just oil and gas. I think you're going to see bigger players come in. And when they come in, they're going to prioritize North American assets because they also see same geopolitical risk that you and I see. Mm-hmm. And I think UEC's got a very strategic platform today because we control, after Cameco, the second largest diversified resource portfolio for uranium in North America. That's 328 million pounds of uranium resources in the ground in all categories, from Texas, Wyoming, all the way to Saskatchewan. 5 joint ventures and partnerships, not just with Cameco, but with the French government, Orano, on 2 of their projects in Canada. So this is a very unique portfolio, Frank, and it's impossible to replicate what we've done today. It's impossible because the only way you could have cherry-picked and put this portfolio together is if you sat there patiently for 18 years and found a way to do deals, found a way to raise money, found a way to put things together so that you can grow when prices were at $20, $30, and even $40 per pound. And that's exactly what we did. It would be impossible to replicate that today. No one cared about this industry when it was trading at $20 a pound for one business reason. The industry didn't generate free cash flow. At $75 uranium and rising, the industry will collectively start to generate more and more free cash flow. And that's what the diversified miners look for. That's what the oil and gas industry looks for. And that's when our sector, I think, is going to become much more interesting to much bigger players than the names we're used to hearing about in uranium land.
So this Cameco said, okay, and I wanted to bring this up because I wanted to get this right in a quote. So this is when they just reported earnings, great numbers, right, across the board. They said something that surprised me. They said demand for nuclear, and I'm quoting them, demand for nuclear power supported by growth across the near, medium, and long term is driving the best fundamentals we have ever seen for the nuclear fuel market. Okay. We're talking about pre-Fukushima, prices well over 100. Do you feel the same way? Because this is a company that's been doing this for, I want to say, 3 to 4 decades? You don't usually see them go out and say something like that. Are you seeing that same thing? Is this the best that you've ever seen from a fundamental standpoint with everything that we've explained today? I mean, are you in agreement with that? Or, because to me, that was a really bold statement considering they've been in the industry for so long and where prices have gone and where we've seen them gone pre-Fukushima.
It's the best I've seen in the 20 years I've been doing this. And we may never see it this good again because it's so good right now. Because we lived through 20 really bad years. Like I said, 20 years have gone by where we've had cumulative 2 good years and 18 bad years. That's what underpins the problems we're having on the supply side today. So for things to look as great as they do, both on supply and demand side, you must have kind of gone through the rite of passage. You must have gone through something prior to create the opportunity set moving forward, right? And on the supply side, we've lived through the worst for 20 years, which is what sets up the supply deficit. And on the demand side, we have this incredible, never seen before consensus, acceptance developing around policy that favors growth in nuclear energy that the world has never seen before. And maybe, again, it's driven by issues around decarbonization. Maybe it's driven by electrification, but we have just never seen a setup like this. And to throw geopolitical tension into the mix with the war and with sanctions and with issues around needing to really get the Russian situation under control, you just could not have written a script like this. Mm-hmm. But it's happened. It's in front of us. It's unfolding, and it's. But yeah, I would agree with that. And but I think we have to appreciate what's taken to get here. And and that's what makes the potential for what we're talking about as an opportunity so strong.
And I think your shareholders are going to appreciate that, the process of getting here and seeing you at the conferences for the last 10 years, and seeing you taking the time to speak to individual investors, which you don't see a lot of people do. And I saw that firsthand. So I'm glad you're all in on this. I was glad that you didn't say, hey, you know what, I might take a little back seat and have like, passive role. I love the fact that you're all in. I love that your position here couldn't happen to a better guy. And I know how hard you work to achieve this, how hard the balance is to get here, where it's work and family. And I deal with some crazy stuff as well. So, really, really good stuff. And I think the next leg is going to be even better for you. And I hope it is, because you certainly deserve it. Now, that's the last compliment I'm going to give you, because before we go, there's something that you always do that there's a really cool, good looking podcast host that has an opening, and I think you know how to mimic it. How do you do it?
Hey, how's it going out there?
Every time we meet, he makes fun of me and everybody laughs. So I had to get that on tape. So listen, Amir, thanks so much. It's been too long since you joined me, but it's really nice to go from January of what you said till today. And now, your predictions going forward. Let's see if we can meet. Hopefully those predictions come to fruition a lot quicker than 10, 11 months. But thank you so much for joining us, taking the time, man. And really, really great stuff. Thanks, buddy.
Okay, Frank, I appreciate it. And hey, just last thing, open invitation. I know you've done site visits to Wyoming in the past, but you haven't been to our projects in Wyoming, and love to host you at a site visit to see the next uranium mine in the US coming into production. So maybe we get you down there, and maybe the next time I'm on your podcast, we do it live from site in Wyoming. And that could be something to look forward to. So let me know if you're interested in that, and we can maybe plan that for the new year.
That sounds great. I know a lot of my investors would be interested as well, and Curzio One members. I know we tried to plan something like this not too long ago, and that's on me, because it's been really crazy with the business and everything, but and moving and the new house. But that sounds like a plan. I'm going to take you up on that, man.
There we go. Done. Thanks for having me today.
All right, you got it, buddy. Take care.
Take care.
Wall Street Unplugged is produced by Curzio Research, one of the most respected financial media companies in the industry. The information presented on Wall Street Unplugged is the opinion of its host and guests. You should not base your investment decisions solely on this broadcast. Remember, it's your money and your responsibility.